What's up, everyone? It's Scotty with Money Investing. We just got a banger jobs report with over 250,000 jobs added in the month of April, with the unemployment rate edging lower to 3.4%. I'm going to break that down in this video and talk a little bit about the market's reaction and what the implication could really be for such a strong jobs report. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, link to our Discord, Patreon is going to be down below if you're interested in joining us. And of course, getting access to all the buy and sell alerts, options alerts, trade ideas, everything's going to be included, as well as the private live streams and the private updates and private videos as well. So link's going to be down below. So this right here is the actual report. Jobs growth totals 253,000 in April, beating expectations. So expectations were 180,000 jobs, and the unemployment rate now sitting at 3.4% against the estimates of 3.6%. In fact, getting down to 3.4% from 3.5%, and the lowest level since 1969. So we're going back over 50 years, I think, if I'm doing my mental math right. 1969 is 54 years is when we are going back. This is the strongest and the most resilient labor market in over 54 years, and we are still waiting for these cracks to show up in the labor market, because we've had big tech and even financial companies report layoffs every single month. The last 6 months, we've had so many companies report layoffs and job cuts, and yet they're still not showing up. Still, it is continue to be very, very strong. And the average hourly earnings also did increase 0.5%. Now, that is where the issue is. I'm going to go over that in just a minute, but job growth fared better than expected in April despite the bank turmoil and decelerating economy, and we added over 253,000 jobs. So again, these are non-farm payrolls. So we're not talking about farming and agriculture, but really just private and more government jobs in different sectors: manufacturing, construction, of course, tech, all those different sectors. And this right here is the average hourly earnings. Now, unemployment rate was 3.4%. However, the average hourly earnings, a key inflation barometer, rose 0.5% for the month, and up from 0.3%, which was the estimate. And on an annual basis, wages increased 4.4%, higher than the expectations of 4.2%. Now, the issue with this picture is that wages are up, labor market is extremely strong with a really low unemployment rate, 54-year low, and yet inflation, because of those wages and then some of the other parts of the economy as well, it's possible that if it stays higher, that gives the Federal Reserve very much a green light. I mean, this is literally a recipe to do further rate increases, to continue to hike, because the economy is strong. We're not seeing weakness in the economy. The reason for the job cuts really is that the economy is weakening, right? We're seeing unemployment go up. There's recession indicators. This labor market is anything, it's far from a recession indicator. It's anything but a recession indicator, because it's really, really tight and it's very competitive. Professional and business services led the job gains with an increase of 43,000, and that was followed by healthcare 40,000, leisure hospitality 31,000, and social assistance at 25,000. And despite the serious banking industry troubles, jobs in finance increased 23,000. Government hirings also rose 23,000. Now, we did see some downward revisions in the previous months, which were pretty dramatic. So March's count was slashed to 165,000, down 71,000 from the initial estimate, which is a pretty significant revision, right? So I am not even sure if this 253,000 is actually the correct number, because, and then while February also saw a 78,000 job reduction. Can you imagine? That's a huge decline. I mean, let's just do the math, right? 70 divided by 248. That's a 30% decline. So if we are going with 30% just to be on the safe side, then today's jobs report is really adding close to 177,000 jobs. We're going to have to wait and see where that revision lands. But from March, it was slashed by 71,000. In February, that fell to about 250,000, a reduction of 78,000. And the household survey, which is used to calculate the unemployment rate, showed that a softer total jobs gain of 139,000. So I'm not even sure whether to trust these numbers anymore, because we're seeing significant, wildly different numbers when it comes to the survey, when it comes to the actual, and then when it comes to the revisions that happen a month later. This right here is the broken down by industry and sector specifically. So you'll notice that again, the professional business services, private education, and health services and did see a pretty significant increase of about 60, 70,000 jobs. Again, government adding 23,000, leisure hospitality also adding 30,000. But my main focus, as I mentioned before, is on construction and manufacturing. And in the past month, we have seen them pretty much break even or a decline for the month. And for this month, we did see about a 10 to 15,000 jobs added in those two sectors respectively, which is, again, I would say somewhat strong, not obviously as strong as what we've seen before, but it's definitely been slowing down. And this is one of the leading indicators, right? In the jobs report, construction and manufacturing employment is one of the leading indicators for a potential recession. And this right here is what the market's pricing in for interest rates. As I mentioned before, a strong labor market and higher inflation still gives the Fed a green light to continue to raise interest rates. Despite what's happening with the banking sector, the banking crisis, and the turmoil, a strong labor market is one of the foundational indicators of a strong economy. If unemployment doesn't go up, the Fed has literally no reason to start cutting rates. And right now, the market's expecting significant rate cuts. As we have talked about on the channel before, the discrepancy continues to widen. And we're seeing, as of June, the market's pricing in about a 97% probability that the Fed is going to hold rates at these levels. 62% probability that we're going to see another pause and, rates are going to be held at this level at 5 to 5.25%. And then starting in September, this is where we are expecting the Federal Reserve to start cutting rates. 1, 2, 3, 4, 5, 6, 7, 8, 9 rate cuts now priced in till November of 2024. That's what the market's expecting. And so if you come over to pre-market, we are green. So this is when the report came out. So we were seeing a bit of a decline. So NASDAQ here specifically dropped about 30, 40 basis points and we recovered fairly quickly. And right now we're up over 69 basis points and the S&P SPY is up over 88 basis points. We're seeing a lot of momentum and a lot of greenery pre-market, so it's going to be quite interesting how we trade intraday, but we just got to keep in mind that a strong labor market, although strong for the economy, is maybe not so much on the quantitative easing front, which is what the market's pricing in at the moment with the Fed funds futures, because again, strong labor market means the economy is able to handle all the rate hikes that we've seen so far, and it might as well just continue to handle them. So we might maybe see a little bit of a longer pause, so the Fed maybe does not cut rates as quickly as what the market's pricing in, or maybe even they start to look into raising interest rates if inflation doesn't come down fast enough to their target. So just some things to consider because there's always a bullish and a bearish perspective. It's all about optics, and from a more objective standpoint, I think it's just a sign that we're seeing the economy still very resilient. But then again, the question is, are these numbers even accurate? Because we're seeing so many revisions on the downside every single month. And not to mention the separate surveys are showing us a total jobs gain of about 139,000. So let me know your thoughts down in the comment section below. Again, we're very much at a resistance on the S&P and the NASDAQ. You've got the S&P with a very red week so far, down about 2.6%. So we'll see if the markets can turn that around today. But we're still very much getting rejected at that bear camp. And then not to mention the NASDAQ also getting a rejection there at 12,300, down over 2% on the week. And we'll see whether the markets have what it takes to kind of turn things around a little bit on the day today. So hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. Link to our Discord and Patreon is going to be down below. Again, the first week of the month is the best time to join, so you can get access to all the alerts, all the private videos, live streams, all that stuff. As always, happy investing. I'll see you all in the next video.